the levels which have been articulated before, where by 2016 it will be even below 5%. Now, of course, this will require enormous discipline on the part of the government and the authorities to meet that target. But the past track record is positive in terms of achieving those milestones. Also, there is a commitment to maintain inflation at a single-digit level. Next year, it's expected to be 7%, and then for it to be brought down further. With regard to exchange rate, another very, very important economic variable, His Excellency President articulated several times in the budget speech the term flexible exchange rate. So, all these added together, in terms of policy consistency, which is a fundamental requirement for rapid economic growth, is provided in the budget. Now, there are also proposals for deepening of the capital market and also for relaxation of the foreign exchange markets. They are also going to be helpful. Challenges, so having said it, what we will have to look out for are two challenges, I think. One is the adverse global scenario. Second is the need to exercise restraint and very high level of fiscal discipline to meet those budget deficit and inflation targets. But I think if there is a will, there is a way. So the vision is very clear. I might add one more thing. The support to agriculture sector and also for small and medium enterprises is also a very important element in this strategy mix. So we would hope that there will be all the strength and commitment required to stick to these proposals. But at the same time, bear in mind that the global economy is not going to help us in the short term because of the crisis faced by the developing countries right now. It may begin to ease hopefully from the latter part of next year. So end of the day, Riaz, I think it's not so much about what's stated here, but about how we are going to implement them and how we are going to stick to these commitments through the period, not through just this year, but right through till the end of 2016.
Okay, thanks, Anurag. I think that was a good start to the discussion. Can I ask Suresh to quickly take us one proposal?
Right. As we all know, during the past few years, there was a trend to relax the exchange controls. And in this budget, also, we see that there are few proposals with regard to relaxation of exchange controls. There is a very interesting proposal to permit corporate entities to borrow up to $10 million per annum over the next 3 years. Not only that, licensed commercial banks have been permitted to borrow up to $50 million per annum for 3 years. Now, this proposal permits a bank to borrow $50 million per year. So in all 3 years, the bank can borrow $50 million a year. Then there's another proposal to transfer the residents' foreign savings to investment up to $5 million, and there's a 3-year tax holiday granted. And there is a permission granted to service providers to tourism and foreign businesses to accept foreign currency. Now, as we all know, under Section 5 of the Exchange Control Act, a person cannot transact in foreign currency unless there is an exception given. No person can accept foreign currency. Now, this proposal is to permit service providers to accept payments in foreign currency from tourism, businesses related to tourism and foreign businesses.
Okay, Suresh, I think we got some very interesting proposals out there, and I'm going to have to ask Tia and Hiran to respond, but giving you little time to prepare, we just have a quick break and we'll be right back. Okay, welcome back everybody. We had some very interesting proposals. The first opening proposals, I might say, on exchange control relaxation. And I'm going to bring the banker on the panel to tell me, what do you think of it?
I think we welcome the further relaxation of exchange control, which I think creates a more enabling environment, which has been, I think, the consistent thrust of this whole budget. I believe the notable things are the fact that commercial banks and corporates are now able to go out if their balance sheets and business case makes sense and borrow money. I think banks are allowed to borrow up to $50 million per annum without having to knock at the door and wait in a queue at the central bank, which I think is a administrative relaxation, which I think is more than welcome. Banks have in the past, some of the banks have been borrowing, but I think this will give them the motivation to capture specific windows of opportunity in global markets, because timing is very, very important, and go out instead of having to delay the process. So I think that's very much welcome. There can always be an argument about the tenor and the ability to hedge, but I think the proposals give the discretion to the banks to decide on the tenor themselves depending on the need and their ability to hedge. So I think that's a very welcome proposal. The ability or encouragement for Sri Lankans working and living abroad to bring money back here, regardless of a specific purpose of deployment here, I think again gives the encouragement for foreign currency to be brought back into the country, which again is a mechanism, I think, a measure to support the balance of payments, which I'm sure will be very positively welcome, especially in an environment where global interest rates are challenging. So those two are certainly welcome.
Okay, thanks. Yeah, I'm going to turn to Hiran. As an industry where you receive a lot of foreign currency, and how do you see this proposal?
It's fantastic. I mean, I think it's, from what I understand, it's not only for tourism but many other sectors as well. But it certainly will help and cushion the hotel industry, the hospitality industry a lot more, because that will, I mean, obviously we accepting more foreign currency means, and having to pay back the banks in those currencies will cushion us, because the cost of borrowing will come down, and that'll help us to invest much more on the plant, because as we are expecting over 2 million tourists to reach also by 2016, that means more hotels will have to be built, and if we are to borrow in rupees, it's going to cost us a lot more. So this is really helping the hospitality industry a lot more. Also the travel agencies as well, because they can import better vehicles, they can invest more on their own infrastructure, the software part, and even human resource development. So I think it's going to boost the tourism industry a lot more.
Wait, Gaon, I'm going to ask, I mean, is it only for the hotel industry? Can a hairdresser, for example, who gets foreign currency do this?
Yes, they could. The idea behind it is to make business convenient, one side, so that it's much easier for them to be competitive, and also to encourage businesses to accept foreign currency so that they can do it much easier. The other part of it is, again, I would like to add to what Tia mentioned, that is, you see, while it will support the balance of payment, we are also now beginning to understand that our corporates have advanced to a level where they could take their decisions themselves. So we have confidence in them, and we believe that they have now reached a maturity stage which can now be recognized by the rest of the world as well. And with that, we believe that they will be good recipients of foreign investment as well, directly to them. As you know, when we are moving towards the $4,000 per capita income, a $100 billion economy, we will need to have at least a 35% investment made into the country as a percentage of GDP. Now that entire investment cannot come locally. A part of it has to come from abroad, and if you can make it easier for people to bring that investment, we don't have any red tape, we don't have any complications, and we allow the mature businesses to receive that, then I think a major portion of that investment that has to come in will come from savings from outside. So that's the background to this proposal of His Excellency the President, and I think as you go along there will be many takers of this proposal, and we would see the gap where we now have, as Andrew mentioned, we need to have that investment to come in, and if there is a gap between the local investment and the foreign and the investment that we really need to have, that portion will be now brought in by the foreign investment.
Okay, I'm going to have a quick comment from Hemaka before we go for a break.
Right.
Hemaka?
Yes, as regards to former DFIs, the Development Finance Institutions, there's a special proposal where the government would hedge the foreign currency risk, and we've been encouraged to borrow 10 years up to a sum of $250 million. Now, that's a very interesting proposal because currently we've been borrowing something like between $100 and $150 million for an 18-month tenor. So basically, while it's very interesting, there are a few concerns that we have, because on a 10-year tenor there will be a premium risk. You have to pay a higher premium on the interest rates, and on a 10-year span the bank's rating as well as the country's rating would come into play. So we welcome that proposal because country needs capital, and it's a proposal between the government and the foreign DFIs. We welcome it, but we have in mind these risks which we have to worry about. But the big thing about it is that the government is protecting us on the exchange risk.
Okay, great. I need to go for a break, but I'm sure we will have a lot more to say on this, and I'm going to continue this just after the break. We'll be right back.